became quickly aware that our water infrastructure is very sick. It's in deep trouble. And it's being underlined by these little canary in a coal mine events like Flint, Michigan, and so forth. But there's much more happening that is just not being talked about. For example, you can go to a tap water database called ewg.org/tapwater, Environmental Working Group, and look up your zip code, and it will tell you, oh, your zip code is fully compliant with federal regulations, but it's 2,000% too much arsenic by current science. They updated the arsenic rules in California a few years ago, and it threw the whole water industry there, and they were tizzy like, oh, Lord, what do we do? They're overloaded. 90% of the burden on municipal infrastructure is industry and agriculture, and it's growing, and it gets more toxic. And it's going to get worse because you know what's coming next is de-globalization, and all the manufacturing is coming back to America. And we're not ready.
And so it is de-globalization. And in fact, the whole de-globalization thing is being driven by global tensions. I'll be covering that. The Suez Canal, Panama Canal. More and more, we're going to turn back into islands, regional islands of commerce. And that means manufacturing coming back to the U.S. with integrated water. And that is going to be the biggest trend of the next quarter century. And Keith Rutten, H2O, 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 Merry Christmas. Ho, ho, ho. That's very cute. I like that. That is good. It is good, my friend. All right. Let's go ahead and do the honors here. So today is Thursday, December 21st, and is briefing number 241. We will have a briefing next week because it's actually, the 25th is Monday. So the 28th will be our last CEO briefing of the year, and we'll make it fun, I guarantee you. All right, so safe harbor statement and the usual disclaimer. All right, so the week's news. Let's take a look at what's going on here. And I'm starting from Thursday, Friday of last week, right, and going forward in time. And so here we go. Well, there was an announcement of conservation plans to basically bring the water levels back onto Lake Mead and Lake Powell. One small problem is that basically it was kind of like a game of whack-a-mole. They're like, okay, we're not going to be putting water in the aquifer, the groundwater anymore. We're going to put it in the lake. Okay, fine. So it actually diverts water that's being used for equally important purposes. However, they are trying hard. And whether you believe there's a hotter and drier future or not, for sure, we are over pumping everything. Okay. Let's take a look at how fun this is. History may not be repeat, but it rhymes. This was, so this is on the 14th, on Thursday. And you can see here, this is the annual change in the inflation rate. So the solid blue line is 2020 to the present. And the dotted red line is 1972 to 83. And it tracks very spooky, very spooky. And so, and sure enough, I think that with what's been going back and forth, first, of course, Powell said we're going to do rate cuts, and then they said, oh no, we're not. But they're going to do rate cuts. They have to for the election. I think they've priced in 3 rate cuts between now and the election. So that's what's going to happen. We are going to get an inflationary spiral. That's just how it's going. Okay. Meanwhile, electricity bills are now the highest in California and Maine, up 51% since 2019. Lord, that's ridiculous. Think about, let's say you're paying $100. Nobody pays $100 for electricity, but let's say you're paying $100. Now you're paying more than $150 in California. So that's pretty ridiculous, but it's also been happening with water and sewage rates, and that's driving independence in energy and in water. Oh, how fun this is. Chapter 11 bankruptcy filings have skyrocketed since the Fed started raising rates. Of course they have, right? And actually, the current president represented his Delaware credit card companies very well with the 2005 law that basically limited how much you could escape credit card debt and bankruptcy. So this is a tough way to go. Bankruptcies You can do what is basically the law says. These are commercial bankruptcy filings, but on the personal side, it's very hard to do Chapter 7, which is just giving up. Chapter 11 is more allowed. Anyway, this is a very problematic situation. And here is the buying power of $1 over time, which you are well aware of, that we are now running at around 18 cents versus 1974. And that 1974 is when Richard Nixon took us off the gold standard. And so we need to think about each year what's happening to our dollar. So if you'd gone, well, I've increased the value of my money by 5x since 1974. Well, you did not keep, you just kept up with inflation. Okay, now cyber attacks. They're trying to figure out ways to secure water systems after cyber attacks. Well, the best way to do it is to decentralize. Why? There's 150,000 individual water systems. Some of the 93% of them are serving fewer than 3,000 people. Incredibly hard to control. And so best way to do this thing is to put the water treatment inside businesses. And that way, you don't have problems with big spills of sewage or whatever. So that is that story. At least I know they're worried about it. Okay, now we were talking last week about the Panama Canal drought, now attacks in the Red Sea. What does that mean? Well, this interesting chart shows us that it takes, if you go from Shanghai to New York via Suez, it's going to take you 5 days longer. But if you go via the Cape of Good Hope, which means you don't use either one, it's 10.5 days, which is massive. And it will have enormous effects on the cost because it basically reduces your ability, the usefulness of a ship by, 25, 30%. And that's huge. That means very similar price rises. Again, this will drive de-globalization. Oh, and the fear and greed index is at extreme greed, which means overbought, which means when you're at extreme greed, then it means that everybody's piling in, and that is exactly when thing flips over into oversold. This is December 18th, and the S&P 500 was pushing toward a record high. And what happened then? Well, we know what happened then. Meanwhile, I'll get to that story, but basically this story in Wall Street Silver, basically FX Hedge wrote a very good article, which basically says that, 3 rate cuts in 2024, and they will print money big time. It's just going to go down. And interestingly enough, all this starts really way back with Volcker, who did 8 years of austerity, and finally Reagan was just like, enough already, enough. And Volcker was replaced by Greenspan, and we went to very low interest rates, and then we went on from there. The first bailout, the housing bubble, which of course we got the Great Recession, 2008, 2009. We definitely got money printing coming for sure. Grant Cardone spoke up. He thinks we're entering the greatest real estate correction in his lifetime. And the issue is that it's not, we know the commercial was in trouble because of COVID and people, a lot of people working from home. So occupancy in a place like New York going down to about 50% currently. Here, this is also residential, because of course, rising costs of mortgages, but also cost of a house is going out of sight and basically a big squeeze. Okay, this is what happened on the 20th. $600 billion of market cap. So remember that back on the 19th, they said it's the highest ever, et cetera. Literally right after that, at around 1:30 p.m. Eastern, big crash, and lost huge gains, basically all the gains that had been won since the Fed chairman had said that we were going to loosen things up. All right, let's take a look then at the chart. Correct. So basically, the Fed chair giveth and the Fed chair giveth, take it away. But what happened here? How did the S&P 500 raise $600 billion worth of market cap? There's a story behind that. But I'll get to that. Meanwhile, let's take a look at Bitcoin ETFs, which You're going to hear about Bitcoin ETFs all over the place. And it's basically they are going to, when you got BlackRock doing an ETF, this is a big deal. And so there's a huge, huge move towards that. And, right now, Bitcoin is about $500 billion in market cap. If it gets to 20 trillion, that is the size of the entire real estate market in America. And it could very easily. That's not out of reason that it would go 40x. So we're going to see that. And the ETFs are going to be the way it goes. You're probably smarter owning Bitcoin itself, but those of us who are stuck with 401ks and so forth, we buy Bitcoin, we'll buy a Bitcoin ETF, right? Right now, for example, I invest my wife's 401k, and I'm invested in something that mirrors Bitcoin, which is Riot, RIOT, which is a Bitcoin mining company. And it moves with Bitcoin, but I'd much rather own Bitcoin itself for sure. Okay, but here's the problem. On top of what's going to go on with this, Washington is apparently looking to ban self-custody of Bitcoin. This is interesting. So again, this is what I'm talking about is all these different commodities and assets classes are already being manipulated, already have a huge amount of money behind them. And that is the problem. California to vote on allowing toilet to tap projects. So that they're doing it. And I personally think they have to. They have to start recycling at the utility level. But that still doesn't get good recycling going. It's going to take forever. To build toilet to tap at the utilities is going to take 2 decades. Whereas you could easily get, with ideas like water on demand, industry and agriculture just recycle their own wastewater and do it much faster. Canada is in the middle of a drought, big time. The red is extreme drought. And then we have, basically it's either normally dry. I don't see any areas that are doing great. Now, S is short term, typically less than 6 months. L is long terms. So where it's L, you've got a problem. Now, Canada gets a lot of rain and snow. So this is not a pretty picture. As a skier, I'm not happy about the droughts. We are actually going to Montana. My wife has a small school. We do an annual ski trip, and we'll be in Montana in January. And whitefish is still very brown. Actually, whitefish replied to this post and said, no, it's just brown in town. It's white on the mountain, but still, it's very thin. Anyway, in Canada, that's of course just below Canada, same climate. Basically, 72% of the country is classified as abnormally dry or in drought. So that's tough for Canada. Commodities, buy commodities, sell bonds. Why? Well, here is net overweight commodities versus minus net overweight bonds. This is an indication of things going well or poorly. The last time it was severely negative was the last big recession. And now we're seeing it happen finally. It didn't really happen during COVID. In fact, we had a huge bounce back in COVID. But now we're looking at a serious drop. And this means that you should probably bail out of commodities and get into bonds. I'm going to go ahead and play this little piece with RJ Ahmed because it's a good one. Here we go.
The reason why we're putting in place water on demand is for the next generation, which is people who would like to have it for 3 reasons. Number 1 is so that they can control their water and sewage rates, which in America are inflating as fast as college tuition, which we know is inflating very fast. Secondly, they can recycle under their own control, which reduces their water costs. And thirdly, they're free of interference from the local government because as long as they meet the requirements, they can just put the water into the ground and everybody's happy. So for those 3 reasons, people will be interested in doing it. And that's when they'll run into the cap capital need. And that's what we're building for, is for in any kind of market, it's an inverse pyramid. You start with the people with a real need, a tiny percentage. They're like, I need it now. I got to have it. This is it. That's, 12, 14% of the market. The much bigger one is the people who have to have it, or who want to have it, who think it's good, to have a strategic need for it. The final third, which is the most of all, is the people who just finally adopt it because everyone else is doing it.
So, you know the story, and get off the grid and control your life, basically. All right, back to that SPY crash. So the S&P 500 ETF trust, which is the oldest ETF in Wall Street. You saw I had that graph earlier with the crash. Well, here it is. It just came crashing down. Now, it has recovered about half of its loss, right? But what happened? What caused this? Huge spike. Look at that huge spike at the very, very bottom. It has a huge spike upwards in volume. And now, right at the very tail end of it, going into the 22nd, just before tomorrow, we have a big peak in volume. In other words, people are buying again, like big time. But it's not a pleasant picture. So what happened? Somebody bought 1 million at the market SPY put contracts. These are contracts that bet that the ETF price will go down just 2 hours before the market sold. And basically 0 days of trading left. In other words, the option that was purchased literally expired today. And so whoever did this had a $15 million option, which inflated to $520 million, which equated to $47 billion. Ridiculous. So that was, somebody came right in and just, boom, just murdered the market. If they can do it once, they'll do it again. So now, some people might think of it as a buying opportunity, but it's also very dangerous. So 0 DTE, 0 days until expiration. That's what that means. So these are options that are right there. And this publisher says that they really should have triggers to prevent this on the last day of an option. All right, let's talk about acquisitions. And I interviewed this afternoon Mr. Bill Charneski. Let's hear what he's got to say. Bill Charneski, how are you, sir?
I'm doing very well, Riggs. Really well. Busy.
Well, busy is good. You've had many lives with first Origin Oil, then OriginClear. And tell us a little bit about, for the people who don't know you well, what you've been for us over the years, and then what your current mission is.
Started with Origin Oil, 10 years ago, maybe a little bit more than that. And we were involved in the algae growth and all of that then. And then over the years, I played many roles, anything from director of engineering to COO to managing the technologies, and most recently was involved in mergers and acquisitions back a couple of years ago. In fact, was very involved in the acquisition of Progressive Water and Modular Water.
Sure.
And then periodically I've been doing projects with rigs, and then a few months ago with what's going on with the merger, rigs decided it was time to repurpose me and have me work on mergers and acquisitions again. Yes. And so actually I love that part.
No, it's fantastic. And you did a great job on Progressive and on bringing us Dan early that we built modular water systems around. Now, I want to make it clear that, yes, we have a definitive agreement for a merger, but our acquisitions plans do not, depend on that exclusively. In other words, we have multiple paths to get there. The acquisitions are not in themselves dependent upon this eventual merger, because you have to have a plan A, a plan B, and plan C, but clearly acquisitions is where it's at. And so tell me, for the audience, what are the stages of an acquisition?
Well, first, obviously, you have to identify the best candidates. Who are the candidates that meet your objectives in the acquisitions? And in this case, our major objective, or one of the objectives, is to vertically integrate modular water. And so we're looking for folks like heavy duty plastic manufacturers, control panel manufacturers, wastewater engineers, that kind of thing. That's kind of phase one, but simultaneously, we're looking for a software company that can help us with the water on demand part of the business. Because we can grow the commercial sale of this equipment, but our real purpose is to have a water on demand where individual investors can invest in water as an asset. And then we can create a mechanism for our end-use customers to initiate or to buy equipment without a big capital cost, so they can do it with a water on demand or a water flow basis. And so another really important part of the acquisition is to find a software company that can help us manage that, because it's going to grow rapidly.
Okay, so you've got, and we'll talk more about these targets, but now let's say you've got a short list of companies that you're interested in. Where do you go from there typically?
Well, from there, once we identify them, then we, got to introduce them, start having some conversations with them, get them interested in the acquisition and being part of a group of companies that we're building. And once they're interested, we obviously have to do an NDA, and then we have to begin that evaluation process where we get their historical financials, get their projections for the future, look at their balance sheet, look at the company overall, and put together a term sheet for a non-binding LOI. Mm-hmm. And that non-binding LOI we would then take to that particular company and present it to them. And if they were interested in pursuing that, then we have a non-binding LOI that we can move forward with. And when we're ready to close on that acquisition, we move on to a definitive agreement, the due diligence, and closing the acquisition.
As I recall, the time between, in the case of PWT, the definitive agreement was, I think, sometime in July, and we finally closed in October, something like that.
Yeah, a good part of that was the fact that PWT had been a proprietary, a single proprietor, and so they did not have any audited statements, financials. And so that whole process of seeing audited financials took several months. The other parts of the due diligence took place kind of simultaneously, but the due diligence was a big part of it. And that's not untypical for companies that are in the $4 or $5 million range. They typically aren't audited. When you're dealing with companies that are 10 million plus, typically they're audited, and that doesn't take as long that way.
Yes. Well, obviously there's a lot of due diligence, hard work in between all that. And, there's a mix of cash and stock. In the case of Progressive, it was all stock. Various ways to get it done. So what I thought I would do is put up on screen. This is from the PowerPoint that's actually on our website under presentations. And this is the section where we start talking about acquisitions, where instead of in addition to the organic growth, we want to have some buying to do the buy versus build. And as you were mentioning, number one, we have this agreement in principle to acquire a cloud software company that was already announced. And they have an existing business, and right now they're evaluating how they could help us build this network management system on top of it. Number two, of course, as you said, vertical integration, bringing in the manufacturing centers to support modular water systems. And then also expert staffing, because both modular water and Progressive desperately they're growing much faster than they can get personnel. And it's in a way easier to buy an engineering company than to hire 40 people kind of thing. So engineering companies, water service companies, and that is the third big leg. So then I'm not going to go through these parameters too much, but these are basically the assumptions made for these targets. But this is really the immediate phase we're looking at here. Now, phase one begins with Q3 2024. Well, here we are, Q4 2023. We're 2 quarters away. And really what we're saying is we're using this time now to get things ready, to kind of get ahead of things so that, presumably in Q3, we'd be able to start closing these. This assumes a 25% cash. And there's a very large contribution of revenue from this because, of course, these companies need to be profitable. So there's many more slides on this, and it's very interesting. But I think that kind of gives the parameters that we would be able to more than 10x our revenues by going through an acquisition program. Now, again, I want to emphasize that there's no assurance that we will achieve this, but it's clear that we can, and that we have the ability to do it. We've done it before. We've gotten really good at fundraising, et cetera. So capital is not a major barrier. It's just a matter of execution. So tell me, you told me in a memo yesterday, I think it was, or the day before, that you had 10 companies in your sights. Which categories are these in?
Well, the one that's furthest along is that we're meeting very shortly with the first company and actually going over the term sheet, and we hope to get a non-binding LOI from that within a few days later. The other ones are in various stages. If I go to the other end of the spectrum, there's a couple of companies that are similar but very complementary to modular water that we're looking at. In between, there's some other flat plastic fabricators that are in the process of providing the financials and the projections so they can be evaluated. There's two companies that are software developers, software equipment companies that will, I think, help us in the water on demand management of the cash flow and so forth. So there's I guess one of the things that's interesting is that the people that I've talked to, and I've talked to out of that 10, I've probably talked to 4 of them. There's real interest in being acquired once they understand what our goals are. There's enthusiasm for that. They're anxious to find out more information, and I don't think we're going to have any difficulty finding good candidates that are accretive and that will be very complementary to the plans that we've formulated.
Right. And for the audience, accretive means that it adds to the revenue and profits of the existing company. So as opposed to, let's say, a pure technology purchase where it would not add to our revenues and profits, it would simply be an asset. But we strictly want to do accretive acquisitions because even while we're developing water on demand, we want our conventional businesses to continue to become bigger and more profitable. We've made pretty ambitious projections. So far, it looks like 2023 looks pretty good. But it's going to require a lot of assets to maintain the pace, which is really, really, these units are growing fast. So, I'm so excited about this. This is it's a lot of work, but I consider it a lot of fun. And
I enjoy it. Actually, it's fun meeting people and seeing how people make money.
Amen to that. And I think we'll be, you and I will be doing some touring in the new year. So there'll be more to come. And Bill, I just really want to thank you. It's a pleasure having you working on this project again. And let's kill it. Okay.
All right. Take care.
All right.
Bye-bye.
Happy holidays. All right. Before we were doing these 20-minute excerpts from a podcast, and what we decided to do is instead do short clips, and then I'll be commenting briefly on each one afterwards, and that I think will be more focused. I can comment on specific points that have been selected. So let's get on with it. This is called How to Ride a Roller Coaster, and it's a very, very good podcast, as you will see. Okay, here's the first one.
Sure.
We went, oops, there's going to be a problem. So people are going to be capital starved. In the Carolinas, you've got all those poultry farms that are just dumping nitrates in the river. In Florida, you've got a lot of sewage outflows, for example, that are creating toxic algae in Lake Okeechobee and places like that. There's a lot of problems. And also, think about this. We have antiquated sewer lines. So they break and they start to leak into the groundwater, the aquifer. And now it pollutes that, right? Nobody can dig a well and drink the water out of that well. You have to sanitize it and filter it. It's not clean. Wow. What does that say? That's like pretty horrendous.
Yeah, absolutely. So tell us a little bit more about the water on demand. Is that individualized, or how does that kind of work?
We're targeting industry and agriculture because that's the 90% users. And there's two challenges. The first one is technology. You got to take that big utility scale stuff down to the corner of a brewery, which is going to be 150 square feet.
Yeah.
And we have that. We created a company in 2018 called Modular Water Systems. And it, as the word says, basically, these are water systems in a box. Highly standardized, assembly line. Okay, you want one, boom, we'll get you one quickly. And that has proven to be extremely successful, and it's growing. We were growing all this up until COVID hit. And then when COVID hit, I was like, uh-oh, big reset.
Yeah.
We didn't know in February of 2020 that there would be a bailout, right? The CARES Act, all that stuff.
Sure.
We went, oops, there's going to be a problem. So people are going to be capital starved. And that's when we came up with the other part of it, which is you want a water system and you're a brewery. You don't have $1 million for a water system. You make beer, right? So just sign here. We'll deliver a machine. It remains ours. And we bill you on the meter just like you're accustomed to.
Interesting.
And they go, okay.
Yeah.
Right? And that brings us to the third part, which is how are these machines funded? Well, we made it possible for regular everyday investors to come in and invest in these bundles of water systems, much like an oil well partnership, these master limited partnerships that are a big success.
Yeah.
We're doing it for water. So we like to say water like an oil well.
Okay, so that is the fundamental concept of water on demand, which is water like an oil well, and it's the way to pull the circuit breaker on the problems people have with centralized water, and go ahead and get your own system and not have to pay it up front, and basically replace the central utility, which has all these problems, with a utility which is water on demand, that continues to let the business operate on the meter as it's accustomed to. And that is the revolution we're talking about, especially since regular investors can get involved. And this is obviously unique, as you know. All right, let's go on to the next one.
How can you get in early with something that, 99% of people just don't know? You don't know about those early rounds with Airbnb or Uber or any of those types of companies.
We know that investors like you and me, we're people who do pretty well. And we have a little bit of cash, and like, well, what do I do with it?
Yeah.
You got to put it in, an S&P 500. Like, well, I don't believe that stuff anymore.
Index funds until you finish. Yeah.
So a lot of people are going, well, how do I get an edge? And we know that getting in early on something is good. But, if you look at the Airbnb rounds, you can look it up on the internet. It was all insiders until the IPO.
Yeah.
And so how do you become an insider? So we crafted, it's like, you know what? The water industry is it's exploding, it's breaking out of the monopoly. Let's open it up to regular people. So we have this saying, water is the people's asset, both for consumption, but also for investment. Somebody made a prediction that the first trillionaire is going to be in water. We said, no. We want 1 million millionaires, not 1 trillionaire.
Right.
Let's democratize this thing. Let's have some fun. And for some reason, the elite has not really caught on. It's just beginning. There was a unicorn in May that had all the kind of wonderful, fund support and so forth. But it didn't explode yet the way AI did, right? I mean,
right.
We have the time to do it and do it right, and to have an innovative model that is going to resonate, and then we can start cloning it beyond America.
I think a lot of times people that are in that position, like ourselves, where how do you become somebody that can get in from the ground floor? How can you get in early with something that, 99% of people just don't know? You don't know about those early rounds with Airbnb or Uber or any of those types of companies. Those happen almost in a silo, in a vacuum away from our vision. So this is amazing. And I think that there's so much opportunity for it because, I keep going back to that 20% number. The need is so large. So the opportunity is so great. So, like I said, I love what you guys are doing.
Where all this started was I became furious over time and you may too, at all of the big guys grabbing hold of assets, be it Bill Gates of all the farmland, et cetera. And of course they have the money so they can do it. There's all kinds of asset grabs going on. And we, the people, don't have access to that. It is a crime. It is a scandal. And so what we felt very strongly, Ken and I and the rest of the team, is that we need to make something available to the everyday investor, which is what we specialized in as a company, and do it early so they get the kind of returns that Ashton Kutcher got when he did Airbnb. It was something like 140,000%. It was a lot. God bless Ashton Kutcher. Good for him. But how come we didn't have access? And that's what we are fixing with Water on Demand. We think that's the way to go. The county is going, okay, let's spend billions and connect sewage to every single one of these things. Well, number one, it's supposed to be 6 billion. It'll be 10, 12 by the time they're done. Secondly, it'll tear up streets for 20 years. Take a look at India, where there's a real problem. India is a wonderful subcontinent. It's coming up in the world, but their water infrastructure sucks.
Yeah.
They just basically don't have it. They got people in the sewers who are dying from the sewer gases. They're literally shoveling this stuff. What do? Well, they're not going to, who's going to come up with $500 billion or whatever? That's a huge, huge country.
Yeah.
Well, why not just have decentralized from day one, where it's self-reliant pods, both in industry, in farms, in housing developments, eventually individual homes. It makes a whole lot more sense. And then you have a small municipality to supply the fresh water. The treated water gets recycled, and then they can dump it into the aquifer to recharge it, and everybody's happy. So it's a model that we need to learn from. Let's take a look back home here at Miami-Dade County. It was built without any urban planning back in the day. And so there's about over 100,000 septic tanks in the county. And they fail, they leak, they're literally, because the water level is rising, or maybe the ground's subsiding, I don't know which, but whatever. It's literally these septic systems are coming in contact with the aquifer, and it's a real problem. It's a real, the sanitary issue. So the county is going, okay, let's spend billions and connect sewage to every single one of these things. Well, number one, it's supposed to be 6 billion. It'll be 10, 12 by the time they're done. Secondly, it'll tear up streets for 20 years. Why not just give a rebate to those septic owners to put in one of those self-reliant systems that are mature by now? The poop goes into a sludge tank that gets emptied out once a year by a truck, and that's it. It's done. But here's the problem. Miami-Dade County is not thinking that way. They like sewage. They like pipes. They like to raise a lot of money and have the big plant. But that doesn't solve the problem.
Right.
So here's our approach. We're not talking to Miami-Dade County. We don't talk to late adopters. I learned that in high tech. You talk to the early adopters. You talk to the people who really, really need it. They're being fined, or as we see in North Texas, they're building a housing development that's 20 miles from the local sewage plant, so that's impossible. So they need a self-contained thing. So they know they need it. You don't have to market it to them. They know, I got to have this thing. It's a flying J in the middle of the country on a freeway. Yeah. No connection to anything. It needs its own sewage connection. RV campgrounds, mobile home parks, all that stuff. So the first generation for us is the users that are forced to be self-reliant. This is really talking about how, again, we got very, very frustrated with the state of the water industry, which is highly centralized, very big players, lots of governmental involvement, and nothing much changing. Reminds me a lot of AT&T back in the day, which it wasn't going to change a thing. In fact, there was literally the first person who tried to break that trust got heavily sued by AT&T. So we kind of have a water trust in place, and it's not serving the people. It's not serving businesses either. And it's not handling the droughts well. So the solution then is what we outlined here, which is portability, deployability, and do it yourself, and you have water independence. And that's our vision. Okay, I am going to invite my friends, Ken and AJ, for the freewheeling discussion.
You know how much we love to freewheel.
So there was an interesting debate. Scott Norris brought up the fact that Biden, that the actual bill, I forget what it's called, but it was basically the debt reorganization bill of some kind.
Right. It's,
introduced by a Republican.
yeah, Grassley.
Right. But Senator Biden at the time, he represented Delaware, where all the credit card companies are based, and his support was crucial to getting the bill passed. It would not have happened, in my opinion, without him.
So credit card debt I think it just surpassed $1.6 trillion. We talk about how we're a consumer-based economy. Our economy runs on the fact that people buy stuff. When you hit most of these, I would say a good 80% of middle America, middle class. I'm not talking the poor. I'm talking the people that, 2 working parents and the kids and the dog. Those folks are buying groceries and things like that right now with credit cards. Okay. Christmas will be fueled by credit cards. But here's what happens. Now that credit cards are at 30%, okay, Russian mobsters are blushing at this, okay? When they hit their credit limit and they can no longer buy, this is Toto pulling on the pant leg of the wizard behind the curtain, right? This is just starting and another thing you mentioned about that S&P. So one guy came in with a massive short, a big put buy, and was this a triple witching month?
That's a good question. I don't know. It was just a 0 data expiration is all I know about that.
Because I've sworn off options like like a guy in recovery, right? So I don't follow it anymore. But the point is that he was able to control $48 billion worth of securities with a $15 million purchase. But he made $500 million. The simple fact of the matter is that the market is still vulnerable to, it's not illegal. But he exploited a clear weakness in the system.
Well, it was a buying opportunity, and a lot of people.
Yes, yes, there is. Until it's not.
Triple witching, real fast. That's when the expiration of stock options, index futures, and index options all fall on the same day. And sure enough, the last triple witching was December 15th, 7 days ago.
Right.
So last Friday was the last triple witching, and on the 20th we had this big crash.
Right, and I'm sure that's not a coincidence. So the point I'm making is a single individual with look, $15 million is a lot of money, but not for Wall Street. I mean, that's, it's a rounding error for a guy like Buffett, right? And
supposedly Buffett went all cash. Did you see that?
Yeah, well, yeah. So right. When the market scares Buffett, because I think he knows what he's doing, when the market scares Buffett, be afraid, be very afraid. And I'm not trying to preach fear here. I'm trying to preach prudence. Your interviewer, the gentleman with the goatee, he pointedly mentioned, you're right, we can't just sit here and play these index funds, okay? Because that's a rigged game, right? In other words, all of the institutions go in, they puff these things up, brokers recommend the index funds, some analyst writes a report and says they're pulling their money out, and then you and I get left holding the bag. It's what happens with retail investors. Providing investors an opportunity to be like the big guys were. Look, I talk about in my presentation, when we're breaking up the water monopoly. It's spooky and exciting as hell all in one grand thing. But there's precedent for this. When the telecom monopoly began to break with the sell of breakup of Ma Bell and the Baby Bells. So monopolies don't have innovators. Right? People don't innovate in monopolies. They just plod along like the Borg, absorbing things, right? But when it broke up, all of these innovative people innovative people entered the market because they were taking very small companies down. And if you look at the net size of all of the companies in the space now, right, it's vastly larger than Ma Bell was at its biggest. It's probably an order of magnitude larger. More wealth was created through these innovations, and it gave birth to the modern cell phone industry. I believe we are doing something where we are at the dawn of a whole new technological industry with relation to water by defying it, by decentralizing it. But even with water, I mean, even with telecom, you didn't need to be an insider. You didn't need to be a genius. You didn't need to go, well, I heard that they're going to break up AT&T and the MC. You didn't have to read the tea leaves on the MCI lawsuit. All you had to do was buy 3 retail stocks, SBAC, CCI, and I can't remember the third symbol. Anyway, just $100,000 player, which in like 2002 was about what it is today, a little bit less. And you turn that into tens of millions of dollars, right? That was as a retail investor, but it was literally being a retail investor, not chasing the crowd. It was being a contrarian coming in at the breakup.
That is exactly right. I'm watching Stephen Davis say a couple of things. First of all, he is debunking the idea that it had to do with the witching, triple witching. It was a zero data expiration trade yesterday. It had nothing to do with options expiration on Friday last week because daily S&P options expire every single day. The S&P recovered a little over 50% of yesterday's losses today, which is what I pointed out on that graph. And I believe, based on the volume that we had at the end of the day today, that it's going to retrace completely. So no question about that. However, he also says what investors in water on demand are looking for is regular dependable income, like dividends, not like speculating in daily S&P options, which is subject to market manipulation. Precisely. We are not about the market manipulation here. However, what we are doing in addition to the dividends is, and as Ken is pointing out, is if you can get an early position in a cell phone tower stock or an early Baby Bell stock or in an Apple 1984 and hold it, then you will see outsized returns over time because you're starting so small.
Well, you're not trying to time the top of the wave.
Yeah.
It's like surfing. You got to catch the wave that's going to crest at just the right time. If you've ever surfed, 1 out of 10 waves you actually catch. Okay. Well, if that's your money, that's not a good place to be. So while it requires some patience, and it does require a little bit of foresight, simply targeting industries where the need is global like this, and it's a very Warren Buffett-like mindset. He says, buy things that you use every day. That was what he said, many, many, many years ago. Well, I think water falls into that category.
Well, the thing that you got to understand too, and this is the interesting thing, is there's a lot of people like me who are newer investors, right? And I've never had a lot of faith in the markets, mainly because they're just so volatile, right? Like when the rule is buy on rumor, sell on fact, that makes me uncomfortable as a person that is risk averse. So having something stable, Stephen, like you point out, stable and dependable that we can invest in as an alternative, that I know is going to only continue to do better or at least maintain itself over time, is ultimately what I think a lot of people want. And especially our kind of people that kind of have a natural tendency where you look at that and you go, even if the market does recover, and this is the fun part, right? Even if the market recovers, the fact that it did that gave tons of people gray hair yesterday, right? Or no hair.
No, the little guys were on margin. They're out. They're done.
That's my point is that people look at that and they go, like they're recovering today and they're like, thank God it recovered, right? But it's like if you're in that moment, terrified that you just see the market just going good, even if it goes back up over time, even if you can see the trends, it's still it's heart-wrenching. So again, the stability, the ability to have some faith in something that is a bit more concrete. And when we're talking about, like you said, things that you use every day, fairly certain water just kind of falls into that category.
It's right. Well, that's my sarcasm. The other thing I would say is this: you have a choice. You can enter before the billionaires do, or after. At what point do you think you have a better chance of doing well?
Precisely. I remember in 1984, people were mortgaging their homes to buy Apple stock, and
That's right.
little people did fine. All right. We are at the top of the hour. Scott Norris says, have a very Merry Christmas, guys. Thank
Merry
you.
Christmas, guys.
To you. Enjoy the weekend. Enjoy your Christmas with your family. We'll be on deck next week. A lot of us, for sure. We are doing another briefing, and maybe we'll do a retrospective. That might be a good way to do it.
The year in review.
Year in review. Yes. Time Magazine, year in review. Anyway.
And we don't keep the bloopers.
No, erase.
I know. Those are gone.
All right. Well, thank you very, very much. And I just want to, of course, point out that we have Ken is available to discuss this wonderful people's investment that we've got right here, oc.gold/Ken, you know the number. And also, please fill out your Zoom survey. We do read these to understand how we're doing, what to do next. So don't hesitate. We really appreciate it.
It's also your easiest way to get a hold of Ken, by far.
Yeah, that's true. Stephen Davis.
Unless you're in the next room and you're bringing coffee in.
Yeah.
It's a great way. That's a great way to get my attention as well.
It is a great
Stephen
way.
Davis says, thank you. Well, yeah, good coffee. Thank you for a great CEO update. If you'd like me to talk more about speculation versus long-term investing, I'd be happy to have a chat. We might take you up on that, Stephen. That's a very good idea.
And you know what? You have to talk to Steve. Steven's got this amazing radio voice.
All right. Even better. Thank you all. Have a good weekend. Merry Christmas to you. And I'll see you next Thursday, the 28th.
All right. See you, buddy.